Good morning, everybody. Thank you for attending this webinar where we will cover reporting and disclosures under the new SORP. I'm Cara Turtington. For those of you who don't know me, I'm an audit partner here at Safri and the head of our charities team. So in the hour or just less that we have together this morning, we are going to focus on the main changes that the updated SORP brings and the conversations you need to be having as management teams and trustees before implementation to make sure that you are well prepared for the changes. The aim of today is to hopefully leave you feeling less daunted about the changes that are coming, but with some ideas as to the actions you can take now to enable a smoother transition. But before we get started, some housekeeping. This webinar is being recorded and a copy of the recording and the slides will be sent to you as a follow-up after the webinar is concluded. We will also make the recording available on our website, and that will be available for about a year after today's date. No attendees can be seen or heard, and you shouldn't be able to take yourself off mute during the presentation, which is it's always a relief to me. I'll be answering as many questions as I can at the end of this session, subject to time. When we review the questions, we won't name you, so feel free to ask anything that would be helpful, but we will try to keep both the questions and answers generic rather than getting into any specific situation. If you use the Q&A button at the bottom of the screen, we will get to see those questions and my colleague Helen Wilkie will be helping to filter those so she can pose them to me at the end. If there is anything that you'd rather raise directly, please feel free to email me later today or to reach out to your usual Safri contact after the webinar, and they will also be able to support you. So, we'll start with a quick recap. How did we get here? The FRC has carried out a periodic review of FRS 102, the financial reporting standard for most entities in the UK. The changes reflected in that periodic review are mandatory, and so all other accounting guidance has needed to be updated to reflect those mandatory changes. There are a number of sector-specific statements of recommended practice, or SORPs, including the charity SORP, of course, and so these are all being updated to reflect these mandatory changes to accounting standards. It has also allowed the SORP-making body the opportunity to refresh some of the content and provide clarity on some of their requirements. Just as an aside here, I thought I'd address one of those common misconceptions that we sometimes discuss with clients. Although SORPs are referred to as statements of recommended practice, compliance is a legal requirement for charities, and so even if you don't like some of the changes, they are not optional in most cases, and we'll come on to the most cases shortly. The SORP does use the language of must, should, and may to indicate those items that are mandatory. The musts are mandatory, and departure from anything that the SORP says that you must do is considered to be non-compliant with the SORP or non-compliant with your accounting framework. And if you choose to take that route, then that's a conversation with your auditors around whether there is an adjustment to the audit report. The shoulds are considered best practice. And if you are choosing not to comply with those paragraphs, whilst it won't lead to qualified accounts, you should consider why you're not complying. Whereas the mays are more of a nice to have and something that you may think about, but really they are the additional bits to your accounts. It's also worth noting, of course, at this point that the SORP applies to material items. And so when you're considering the disclosures and adjustments you need to make, the materiality of any disclosure is also worthy of a discussion, particularly if it's something that you don't want to do. So back to the matter in hand. A consultation was launched back around Easter time, and it's fair to say, I think, that some strong feedback was provided to the SORP-making body. This was considered by them, with the final version of the SORP being issued on the 31st of October 2025. It is effective for periods beginning on or after the 1st of January 2026, And so for many of the people on this call, that will be years ending 31st of December 2026 or 31st of March 2027. However, do be aware that if you choose to run a short accounting period, you may need to comply earlier. It's been noted that the revised SORP is around 50% longer than its predecessor and now comes in at over 300 pages. However, it's far from being a one-stop shop. There are a number of places where it refers back to FRS 102. And so if you had planned on just packing the SORP for your fun reading as you depart on your Christmas holidays, you might find that it doesn't give you all of the answers that you need. This will present challenges for many small charities, and particularly, I think, those without qualified accounts staff. Cross-referring between multiple documents does increase the room for error, and so if you've got particular questions and concerns, again, it's worth looking at both the SORP and the accounting standard to see what it says. So the first big change is tiered reporting. And I think this is one that's received significant coverage in the charity press and the other financial reporting at large. So what does tiered reporting mean? The previous SORP categorized charities as smaller or larger. Larger, in the old SORP's language, covered any charity with total income of over £500,000. It was agreed, I think, that this put a disproportionate burden on many smaller organisations as we would think of them in more common parlance. And so the new SORP now categorises charities as Tier 1, Tier 2 and Tier 3, with Tier 1 being the smallest and Tier 3 being the largest. These thresholds are based only on income and are effective in the year that a charity crosses the threshold, without the 2 out of 3 year rules that some of you will be familiar with when reviewing company size thresholds. So you're either in or you're out of your specific tier, and each year needs to be considered on its merits. One of the things you might want to consider if you're close to a threshold, and perhaps may vary year on year, is that generally sticking to the requirements of the larger tier might help you. You can always disclose more, so the tiers really give you the baseline for what you can put in the accounts. And so if you choose to voluntarily disclose more in the years you're below a specific threshold, it might actually be more straightforward for those preparing the accounts and give you confidence that you've correctly calculated the boundaries. In calculating the boundaries, there's a reference to gross income, and the starting point is that you think, well, I can see my total income on the face of the statement of financial activities, but the definition of gross income within the SORP isn't always that straightforward. If you have permanent endowment, if you have legacies that are increasing your endowments, and particularly if you apply total return to your investments, calculating gross income might not be as straightforward as the number on the sofa. And so this needs to be considered. The eagle-eyed among you may also have noted that on the previous slide, the thresholds do not align exactly with either the current or proposed charity scrutiny thresholds or the company size thresholds. And so there's a lot to think about to make sure that you're reporting under the correct regime. That difference between company size thresholds and the tiers is going to have particular relevance in a few slides' time. If you're close to a threshold, it will definitely be worth clarifying exactly what you need to do before you start drafting your first report. It may well be a maths game. The tiering, though, has the biggest impact on the disclosures within the Trustees' annual report. And so as we get into the detail, that is where we will start. Much of the Trustees' report requirements remain broadly unchanged from the previous version of the SORP. And charities are still encouraged to give a fair and balanced view of their activities in a year, reflecting on how their achievements and performance have met their charitable objectives. There are a few more nuanced points, though, that are worth reflecting on here. The revised SORP focuses more on impact reporting and asks that charities consider this specifically when drafting their Trustees' annual report. This requirement that you can see on the screen here applies to all charities in tiers 2 and 3. The text within the SORP sets out the expectation that charities explain the impact they are making on individual beneficiaries and on society as a whole. A number of charities that we work with do this brilliantly already and include case studies and other stories within their Trustees' annual report to really bring their activities to life. That gives those reading the accounts a real sense of the great work that they do and the impact that they have. Not all charities are actively involved in service delivery, though, and charities that provide benefit through other ways may find it harder to comply with these requirements. In particular, grant-making charities will need to think about how they want to tackle this requirement. Your approach may depend on whether your grant-making activities are proactive or reactive, and those making small grants to a wide range of organisations may struggle with this the most. There is no requirement per se that any charity needs to look through the grants that they make and report directly on the activities of their beneficiaries, but some additional reflection on how projects are chosen and how that feeds into the wider public benefit requirements may ultimately help charities feel that they are complying fully with this requirement. The revised SORP also brings in a requirement for charities to report in more detail on sustainability. This is mandatory for those in Tier 3, but encouraged for those in Tiers 1 and 2. There are suggestions that a charity may want to consider setting out its KPIs and explaining those that it is using to manage and respond to climate-related risk. However, this goes beyond climate-related risk and expects you to think about governance matters, which the SORP says may include privacy, cybersecurity, and business risks, as well as employee well-being, board diversity, and local community engagement. As you can see, the requirement in this short sentence is far wider than just environmental considerations and requires the charity to think far wider about its impact on the wider community in which it operates. A comprehensive example for those who might want to go and do a little bit of web searching can be found in the report and accounts of the RNLI, which they include under the heading Integrity. Their introductory paragraph reads, "Integrity is about doing what is right, openly and honestly for the charity as a whole, its people, supporters, volunteers and staff, those it helps and the general public. It includes the use of reliable data, that we put the right lifeboats in the right locations, making sure we spend our supporters' generous donations appropriately, and maintaining the high standards that are essential to any modern emergency service." They go on for 5 or 6 pages to then explain what they are doing in terms of their sustainability and environmental, social and governance reporting. The introduction here shows why they consider it important. The items that they cover then goes on to talk about avoiding conflicts of interest, transparency and donor trust, elimination of modern slavery and human trafficking, ethics in the supply chain, information security, before then talking about the environment. Their commentary on environmental issues isn't just statistics, but it splits their considerations into 5 work streams, as we can see in the infographic or small graphic here that has also been clipped from their accounts. It considers how they are monitoring and reporting internally. Finally, they then go on to set out their equality and fairness in pay, rewards and recognition, and EDI considerations. It's a lot of work, and it's certainly a huge amount of detail in the financial statements. But having a look at this will give you an example of what a charity that has won transparency awards might be thinking. Now, you might be thinking at this point, that's great, but I don't want another 6 or 7 pages in my accounts. And I think with all of these things, you need to be thinking about what's important to your charity, what's important to your stakeholders, and also what's proportionate for the work and reporting that you're trying to do. The specifics around what might be included for environmental reporting are not as prescriptive as the SECR requirements set out for larger companies that some of you may already be complying with. Trustees have more flexibility, potentially, as to how and what they report. If decarbonisation or reviewing your environmental impact, though, is a journey that your charity is on, it's really worth thinking about this now, as showing the KPIs that were set and your progress on meeting them will be difficult to do if you only start this process when preparing your first set of accounts under this SORP. You need to be thinking about the metrics you might wish to report on so that you can ask the relevant people within your organisation to collect data as they go along. It will also help you then, hopefully, show progress from a baseline as you know where you started. There are already some great examples of meaningful reporting on these metrics, and you might want to think about those and what will work for your organisation. It was interesting that in researching this presentation and looking for good examples, I asked Copilot, as so many of us do nowadays, and it immediately highlighted the Greenpeace impact report. This is a separate publication to its annual accounts, though, and the accounts are less clear in how they present the data for the organisation internally. Charity Digital has produced the checklist that I've reproduced on the slide here as to what it considers makes a strong climate impact report, and this might be a checklist that you can use to aid your discussions. Again, it's thinking about particularly being specific, being quantifiable, and trying to be visual in how you present this information so that it is more accessible to a wide variety of your stakeholders. Similarly, with governance, the revised Charity Governance Code was also published early in November 2025. And you may want to build a review of how your charity responds to this into your board cycle over the next year so that you have something to report on in this area. I did look for examples to share on the slides here, but when people report on this well, it isn't a soundbite and it tends to be a little text dense, so it's very hard to produce during a webinar. But we can certainly provide names of those excelling in this way to you outside of this webinar. It's also worth having a look at the PwC Building Trust Awards, which this year were focused on balance in charity reporting. Here you will find some examples of best in class, and I think certainly see some governance sections of a report done well. I think there's a lot to think about here, and as you might see, quite a lot of detail that could go into your report. It is also worth noting, though, that it is possible to provide a website link if this is something you do already produce in an impact report. So using the Greenpeace example, if they are already doing a lot of this work in something that is more visual and meaningful, they can include a web link within their trustees report. However, of course, we would always caveat this by saying if you're going to include a link, you need to be sure that it will work. And so it needs to be quite specific, because as your comms teams update your website, that link that is embedded in your trustees annual report needs to remain relevant. Other changes in the trustees report. Legacies. So the requirement to give a little bit more on legacy income in the trustees report is relevant to charities in tiers 2 and 3. This forms part of the financial review. Whilst many charities, I think, may already have been thinking about this as part of their reserves policies, this is a helpful addition in many ways. Any charity with material legacy debtors should therefore be explicitly including a comment on that within their financial review. And the final larger change, I think, in the Trustees' report is around reserves. Now, I really like this clarity on the reserves policy, and this clarification is applicable to all charities, so those in tiers 1, 2, and 3. You may have in the past had us pesky auditors asking how your free reserves figure was calculated, as it's not always obvious from the financial statements. The requirement now that there is an additional reconciliation should make the accounts easier to interpret for both trustees and other stakeholders. The definition of free reserves has not changed, and so it remains total funds, less restricted and endowed funds, less funds tied up in fixed assets not available for spending, less designated funds set aside for specific future expenditure. There are nuances to this, though, and in each case you have to think about your own specific circumstances. Some people consider their designated funds or expendable endowments to form part of their funds available for spending, as they are within the trustee's discretion. Others clearly feel that they are not. Some people might consider mortgages as being intrinsically linked to the value of their fixed assets, and so exclude those liabilities from the commitments, so as to give a net position. Where adjustments like these are being made, providing a reconciliation so that the calculation of free reserves and how it ties into the balance sheet will be appreciated, I'm sure, by auditors and trustees alike. There is also a much closer link set out now, I think, between the reserves policy a charity adopts, its free reserves, and going concern. The charity must link any lack of reserves to a consideration of why it considers itself to be a going concern. This might lead you to consider how you disclose and set your reserves target more closely, and I think if you have to give additional narrative here, it will enhance the understanding of how you are thinking about your budgeting and forecasting. Overall, I do think this is a helpful disclosure, but it will certainly be helpful to raise this with trustees when looking at budgets and forecasts for the coming year. And also thinking about how you could set out your reserves considerations more closely. It's also a good opportunity to revisit the consideration of what do we think our free reserves are, what do we think we need, and why. But that's a topic I can talk on for a whole hour on its own, and so just for now, I will keep us moving. I did do a simple example here of what might help. This charity has total funds of 25 million, of which 21 million are unrestricted. However, it discloses free reserves of 7 million. It may well be that if you dig into the funds note for this charity to find more about its designated funds and try adding a few numbers together, you can come up with 7 million. But if part of their endowment is land, for example, you would be making assumptions as a reader of the accounts. So the recommendation would be to include a table, a little like the one on the right here within your trustees report or your notes, so that there's transparency as to what is disclosed. Of course, if your general fund is exactly equal to your free reserves, this might not be necessary and may just form clutter in your accounts, which we'd suggest you cut. But helping your readers understand where you're coming from is normally considered to be helpful. And just before we move on from the trustees' report, I couldn't go past this point without sharing one of my favourite depictions of a reserves policy from a client as a matter of good practice. Rather than only having a dense paragraph of text in the accounts of the Royal Society of Wildlife Trusts definitely aim to make the financial review visually appealing. They set out their reserves policy as a range rather than a single number, and track their progress over time. I would say that this is definitely something to think about when communicating with stakeholders, particularly external funders. And you can see from the chart here that it's quite easy to understand what's happening. And if there were any significant year-on-year fluctuations, you could use text to explain that quite simply underneath this table. So that gives you a canter through the main changes on the Trustees report. What's new on the rest of the financial statements? There has been significant coverage of the changes in the income recognition criteria brought about by FRS 102. These impact corporate entities as well as charities, and so have been discussed for some time. Helen Wilkie and Charlotte Radcliffe from our team presented a webinar about 3 weeks ago that covered these changes in much more detail, and so I will not be dwelling on the calculations and the detail here. But you can go back if you weren't able to attend and find that recording on our website, and I'd recommend you having a look if the high-level summary I give you here makes you think you may have items that will be caught. It is worth reflecting on here, though, that this may be one area where the majority of charities do not need to panic. The changes to the recognition criteria really only apply to contractual income, and even then, it applies to contracts that has multiple parts or multiple benefits. And so many of our clients with investment income, donations, and very simple contractual models won't really feel the impact of this. Other changes to the income module include some additional clarity on accounting for grants received to fund projects and grants received to fund capital expenditure. The expanded information here is helpful and hopefully will provide clarity on when income should be recognised up front and when it can be deferred. As auditors, of course, we would say that the devil is always in the detail of the agreement, and so it's definitely worth looking at these sections afresh when you sign a new agreement. The section on legacy recognition has also been expanded. It may not have sufficient worked examples for some people to be entirely happy with it, but then again, that might be something that is better suited to an additional guidance note rather than being embedded within the main SORP. Overall, though, provided additional detail in this area can only support the users of the accounts, and again, if you have material legacy income, that subsection is definitely worth a read. There is a whole new module, Module 10A, on provisions, contingencies and contingent liabilities. This module will give a lot more detail to those dealing with longer-term commitments and grant making. The concept of discounting commitments to net present value isn't new, but there are certainly clarifications here to point you in the right direction. I know that those starting to explore areas such as green finance will find this useful, and particularly thinking around that discounting concept, which has not often been used in the charity world. Additional clarity is provided on when a provision or accrual is required and what disclosure is needed for items not provided for. And that will certainly be helpful for those with transactions in these areas. In addition, there is more information and some clarity around when funds can be designated to meet future commitments. Specifically, if a charity intends to use funds that it already holds to meet potential liabilities, then designating those funds may be appropriate. However, if the expectation is that the payment of that future liability will be funded wholly out of future income, then no designation should be made. The changes to accounting for leases is the one area that is likely to impact more charities than any of the other numerical changes. As I am sure many of you are aware, the headline is that operating leases are now brought onto the balance sheet as right-of-use assets, with a corresponding commitment for future payments. There are judgments and detailed calculations needed to make these adjustments, And if you have anything but the smallest operating leases, we would advise you to start planning for this now. The webinar that I referred to earlier, presented by Helen and Charlotte, also covers the changes and calculations in some detail, and so I would recommend watching that again if you do want to get into the detail. It is worth noting that comparative figures do not need restating here, but in terms of preparation, making sure that the finance team have a list of all relevant leases and copies of their terms will help you in preparing the draft calculations. And as a trustee, you should gain an understanding of the impact before your first set of accounts are prepared, so that you understand the implications for presentation, disclosure, and implications perhaps on matters like bank covenants, if that is relevant to you. Moving on to cash flows. Now, this change might be a good news for a number of you, but I am afraid I'm about to present this with a potential sting in the tail. The current SORP requires that any larger charity must present a statement of cash flows and cannot take the exemption available for smaller entities in FRS 102. Again, larger here being those with income of more than £500,000. The revised SORP changes this requirement so that a cash flow statement is only mandatory for those charities in Tier 3. Hooray, I might hear you say, I hate doing the cash flow statement. A number of my clients will know that I secretly love reconciling a cash flow statement, but I realise that I am definitely in quite a minority there. However, here's that sting in the tail I mentioned. If you are a medium-sized company, you still need to prepare a cash flow statement. In addition, if you are an unincorporated charity that meets the size criteria of a medium-sized company, you will also still have to include a cash flow statement. So what are those size criteria? To meet the medium size criteria at the point the SORP comes in, you will need to meet 2 out of 3 of these thresholds, and that is turnover or total income of over £15 million, gross assets of £7.5 million, and 50 employees. A number of charities, including, I'm sure, some in the virtual room here, have far less than £15 million turnover, but they do have more than 50 employees and more than £7.5 million of gross assets. And so unfortunately for those charities, there will be no change to the requirement to include a cash flow statement in the financial statements. I also just wanted to reflect back on the first sentence on the previous slide. The SORP reflects that the inclusion of a cash flow statement is not mandatory, but that charities may choose to do so and may benefit from the analysis. I know that many trustees see cash as a key metric of the financial health of their organisation, and understanding the impact of their decisions on cash as well as profit is important to them. Therefore, I think if you are considering removing this page from your accounts, you may wish to discuss this with your trustees in advance to make sure that they are comfortable with the decision and to understand from them if they need any changes to the management information you produce to help them continue to fulfill their duties. We're now getting into the slightly more niche areas, but I think this change has been less well publicised than some of the others I've talked about today. But if you're impacted by it, it could be a significant adjustment and may impact other key ratios in your accounts. Module 21 of the SORP has been updated to align more closely with CC14, the Charity Commission Guidance on Investing. The language has therefore been updated to refer to any investment made for charitable purposes as a social investment and remove the distinction between programme-related and mixed motive investments. A social investment is described as a class of assets that comprises investments made for both financial return and to further the investing charity's purposes. It goes on to say that the expected financial return on a social investment can be a return of some of the money invested, or capital growth, or income. A social investment could also take the form of a guarantee, where the charity takes on the responsibility for paying costs or liabilities that would otherwise be paid for by someone else. However, the question of what is a financial return is not straightforward. Is it the case that you should plan to get back not less than that you put in? Or would a return of £1 be enough? Is it dependent on the level of investment you make in the first place? There is certainly a judgment involved here, and the balance of financial and social return would be judged differently, I'm sure, by different sets of trustees, dependent on their overall aims and objectives. Under the previous SORP, gains and losses on mixed motive and programming-related investments were treated differently, and a mixed motive investment was treated far more akin to a financial investment. Under the revised SORP, gains and losses on all social investments are now treated as either other income or charitable expenditure. And so for those that previously had accounts that they thought of as mixed motive, that could be a real change in treatment. In addition, if you have reported movements in your prior accounts, this is one area where the comparatives would need to be restated and a transition note would be required. So if you're a charity with any type of social investment, be that loans, shares, or other types, this is something to be thinking about sooner rather than later. There has been some clarification to the disclosure requirements for related party transactions. The SORP still requires that all transactions between group entities are disclosed. It also explicitly sets out in Charity 9 that if there are no related party transactions, then that fact must be explicitly stated within the notes to the accounts. There has been no real change to the staff cost disclosure requirements, including the requirement to disclose everybody paid over £60,000 in bandings of £10,000. I think many people in my position were hoping that this may get reviewed in light of inflation, but that has not been the case. There has also been no change to the disclosure of termination payments, which I know that many trustees are often uncomfortable with. However, there has been a small clarification on the disclosure of ex gratia payments. I raise this here, though, as I think the majority of cases where a charity refers to a termination payment as ex gratia may not truly be an ex gratia payment, as it arises as a result of a legal obligation. Therefore, making sure that we are careful with the language we use can help aid the understanding of the users of the accounts. As always, where there are staff restructures and sensitive information, it is worth discussing the disclosure of these with your trustees and your auditors before the accounts are finalised. And just finally, a couple of other points that might be worth doing a little bit of reading around if they're relevant to you include the disclosure of revaluation and fair value reserves for charitable companies only, and the treatment of donated heritage assets. I'm not going to dwell on these as time is marching on, of course, but if you do have questions around these areas, I certainly think there have been some helpful clarifications within the language of the SORP, and it's worth reading these quite short sections if these are transactions that you deal with on a regular basis. So in conclusion, you might like it or loathe it, but the state changes in the new SORP are here, and the implementation date will fly towards us quicker than Santa on his sleigh. There are definitely things that you can do now to prepare, both in terms of considering the data you need to collect and the changes you need to make, but just as importantly, you need to support your trustees in understanding some of these changes so that you can report meaningfully and in a way that adds value to your organisation. I often comment when doing training on charity finance and accounts preparation that if there is a lot that you collate and do only for the annual accounts, you probably need to question whether it's necessary or whether you're using the right metrics in the year-end financial statements. So think about what you might want to say and how to say it impactfully without simply adding more and more to the length of the document and the workload of your teams. Align your financial reporting between your management accounts and your year-end accounts where you can, and the process will probably be far smoother for you. And with that, I will hand over to Helen to see if there are any questions you have raised that I might be able to answer, and I will also take a quick swig of water.
Excellent. Thank you so much, Cara, for that sort of canter through, covering a wide range of areas. And I thought if I kick off, I did think you might want a glass of water. There's some easy questions, or at least straightforward questions, just asking for some clarification on a couple of points. The first one is in terms of when the changes kick in, which accounting periods is it for? Is it periods commencing 1 Jan 25? So it would first impact sort of probably December year ends this year, or is it 1 Jan 26?
Yes, so this is definitely for 1 Jan 26. So the first year-long periods that this would apply to is the year ended 31st December 2026. So nothing for the year end that you're about to hit. I guess the slight caveats around that is if you do have any of those income transactions that I referred to, or those social investments, you do have to restate your 2025 figures, but only publish that in your 2026 accounts. Likewise, if you're a March year end, that's your 2027 accounts with your 2026 restated. There is the option, I guess it's worth saying, Helen, of early adopting, but if you choose to early adopt, you have to do everything in the new SORP. You can't pick or choose, and so I don't think that's going to be done widely, if I'm honest.
I would agree. Most people keen to follow the curve rather than lead from the front. The other point of clarification, a couple of people have asked this on different angles, is when looking at tiering and when looking at size thresholds for sort of company financial thresholds, when you're looking at those financial thresholds for charity, particularly for charitable groups, do you look at group income and group assets, group employee numbers, or are you focused purely on the parent entity?
Yes, so if you're reporting as a group, then you look at the group numbers.
Lovely. And one final simple one. What is a legacy debtor? I think it's simple because we come across them all the time, but
All the
actually
time.
probably an odd concept if you don't come across it.
Yes. So as you may be aware from your private life, when somebody dies, it can take months or years for the whole of their estate to be settled and be in a position where it can be paid out in cash. Now, there are challenges, particularly for charities that receive money as a residuary legacy, so a share of whatever is left after specific gifts have been paid out, as to the timing of when that money might be received. And at a certain point in that journey, a charity may recognize the income that they know that they're going to get because it meets the income recognition criteria, but before they have the cash. And so a legacy debtor would be the amount that is owed to you on legacy income.
Marvellous. We've then got a few questions around impact reporting. Starting with a bit of a sort of a look back and reflection on where we are now. For charities who are preparing their accounts now and their annual reports now under current SORP, are there required disclosures that they're required to make in relation to impact?
The word impact, I don't think, is explicit in the current SORP. So you are required to report your achievements and performance, your future plans. The wording is slightly different. Now, of course, in reflecting on what you intended to do what you did and how successful you were in doing it, which I think is where we were in SORP reporting when the SORP 2015 came in. It might be impact by another name, but I think what we're being pushed towards now is clearer and probably more detailed. So your current accounts being produced under the current SORP, yes, the requirement is more about what did you intend to do? What did you do? Did it work? And it's a little bit less, I think, around how did the wider world benefit from that?
And for smaller charities, again, on this kind of theme of impact reporting and reporting changes more generally, do you have any tips for how you'd suggest that smaller charities approach this to ensure that reporting is proportionate and doesn't take undue time and effort for small teams, while still not being a tick box exercise?
Hmm. So I think my starting point with any charity, and particularly smaller charities, is to take two steps back and say, what do we use our accounts for? And if even as a small charity, your accounts are being used hugely to support your fundraising activities, um, that they're going to a lot of trusts and foundations, sophisticated donors who would be um, very engaged in this world, then you're probably going to need to do some of these things, albeit um, without turning your accounts into war and peace. But if you are delivering services and trying to fundraise, those points I raised around potentially including case studies, specific examples of what you have done, I think that could really help you. At the other end of the spectrum, if you are looking at this as a small charity, maybe you've got a £10 million endowment that generates £300,000 worth of investment income, you are in that small tier one category. Um, Giving people a little bit more information about what you do is proportionate, but trying to then ask, I don't know, 10 of your beneficiary charities to give you their stories is probably going to be disproportionate. So really think about how your accounts are used.
Fab. And more on a similar vein. So people now are already many times reporting quite a lot on impact. So they're reporting on achievements, future plans. They might also be doing separate impact reports. Do the new requirements replace that? Can people carry on as they were and add more in? What's your thoughts?
Um, so again, I think it's thinking about how you've used that impact report. I think the helpful clarification that if you already have an excellent impact report or sustainability report, you can link that in. So you don't have to reproduce the whole document in two places is really helpful. So this is not about changing things. You need to think about what's the most efficient way of doing what you do. So I think it's enhancing what the trustees report needs to communicate, but it doesn't need to be in a wholly different document.
And if you're already reporting on your achievements and your activity, maybe you've even got some KPIs, would you envisage people having a separate section on impact, or really adapting and rethinking and taking a fresh look at what they're doing already, or perhaps even case by case?
Yeah, again, I think the SORP is definitely not a tick box. You don't have to have every heading that it sets out for you in the order it sets out in the SORP. So if you already report um, in a storytelling format, you don't then need to pull that out to show impact and sustainability if it's part of your conversation of everything that's happened within your organization in the year, or if you set that out because you have two distinct activities and you report on them as two stories within your trustees annual report. You don't need to revisit the entire layout of your report. This is more about thinking, have we said enough? Do we communicate clearly?
Excellent. And if I take us on to income, which
Mhm.
I know was covered in the kind of previous webinar that we mentioned, and somebody's asked where that's located. It's located on our website. If you need any more information, drop us a line and we can send it to you a link. But in terms of income streams, they've asked, are we aware of any particular income streams that are likely to be impacted by the new 5-step income recognition model for contracts with customers, particularly for schools? And I appreciate schools might be getting into a bit more depth, but maybe it helps to give an example of things to be thinking about when you get into the industry-specific
Mhm.
areas.
Yeah. So I think things that may be impacted, certainly memberships where you're buying specific benefits, sponsorship, and they're obviously not school specific, but I think a real one to think about for charities that have commercial participator agreements or sponsorship agreements that cover more than 1 year. They are things that will absolutely fly out. For schools, I don't think there is going to be a massive change when it comes to standard school fee income. Again, you'd be looking far more at um, those fringe areas. If you have a membership of your sports centre that may be going through the charity or your trading company, sports centre memberships definitely require a little bit of a look. Anything you're doing to monetize your facilities over a longer period. I don't know if there was anything else you'd add to that, Helen, but I think those would be my key look-sees.
I'd agree. I think it's the commercial aspects. If you sort of view the school fees as a charity, it's the commercial aspects that are more likely to be impacted by this, and particularly if there's anything where you have got a bundle of promises, where perhaps you receive a single fee for a contract, but within that there are things you do now, and then there's things you do over time. Under the new model, you'll need to allocate your income from your contract to those different promises. And that may lead to some things being recognised up front that previously you were prorating as part of the whole. But it will be case by case. And a thorny question, Cara. Oh no, you're prepped. We've got a commercially savvy viewer who said, given the potential increase in the scope of work arising from these changes, do we think that that will have an impact on the time the audit team need to spend? And therefore, will there be an impact on fees?
Oh, very commercially savvy. Year one, if you have a lot of complex leases, there will be a couple of hours that the audit team have not previously needed to spend that they will need to go into. Similarly, if you have some of those very complex revenue transactions. Of course, a lot of what we've been talking about here regarding the cash flow statement and the trustees report shouldn't impact the audit fees. Helen kicks me under the virtual desk and goes, don't tell them all that. So the auditor's responsibility as regards the trustees report, of course, is to check that it is not inconsistent with the rest of the document. We do always read it, of course, and we obviously sometimes provide you with helpful feedback, but that should not increase the time that the audit team are spending on the ground. For a charity that has a couple of photocopier leases and not much more, I don't think the impact of this on the audit is going to be that huge. Obviously, it's still a nightmare for the poor finance team preparing the documents in the first place.
Lovely. And I think that draws us to a close.
Well, that is perfect timing. So yeah, I would just, I guess, emphasize at this point, thank you all for attending. And as I mentioned at the beginning, the slides and recording will be sent round in the next week or so. And I guess if we don't see you before, then we wish you a peaceful and very Merry Christmas. And I'm sure we will speak to all of you in the new year, if not before. Thank you very much.